Hello, Accounting 101 students. In this video, we're going to go over how to compute ratios using the comparative statements for Blossom Company with our question 6 in our chapter 13 end of chapter practice. So we have the income statement for 2017 and 2016, and we also have the balance sheet presenting the numbers for 2017 and 2016. And in this problem, we're being told that all sales were on account. We have the net cash provided by operating activities, the capital expenditures, and the cash dividends. And the ratios that we need to compute are listed. So we have A through L, all of these different ratios that we need to be computing using this data. All right. So we're going to be starting off with our earnings per share, and our earnings per share starts off by taking our net income. So the first one is our earnings per share equals our net income minus our preferred dividends, and we're going to divide that by the weighted average shares outstanding. And for the weighted average shares outstanding, this is going to be the number of shares that are outstanding. Okay. And this is going to be of common stock shares. And we'll notice that in this problem, there are no preferred dividends. So we're going to start off with our net income for this year, which is $211,800 minus 0 because there's no preferred dividends. And then we're going to divide that by our number of shares outstanding. And you'll notice that in this problem, they didn't tell us the number of shares outstanding. When we look at the balance sheet and our additional information, there's nothing there that tells us about the number of shares outstanding. But we do have some information that we can utilize to compute this. Namely, we can look at the common stock line item to realize that the number of shares times the par value equals the dollar value reported on the balance sheet. So we can work backwards to get the number of shares that are outstanding. And so for 2017 shares, we would take 290,000 divided by 5, and that will give us 58,000 shares. For 2016 shares, we're going to take $300,000 divided by the $5 par value, and we get 60,000 shares. So our average is going to be 58,000 plus 60,000 divided by 2, so that equals 59,000 shares. So you can see that you need to do a little bit of math in some of your problems. Okay, so I'm going to divide that by 59,000 shares. And for our number of shares, we're going to have our earnings per share of $3.59 for our earnings per share. All right, so that's the first problem that we have. Next, we're going to be doing the return on common stockholders' equity, which will look a little bit similar. So I'm going to erase a few parts of this problem, and we're going to do part B. So return on common stockholders' equity, which will start kind of similarly. We're going to start off with our net income, which is going to be 211,800. And we know in this problem there's no preferred dividends. And this is the top part is going to look similar to the earnings per share. But what's different is that now I'm going to divide that by our average stockholders' equity. So for our average stockholders' equity, I'm going to take the numbers in this problem for stockholders' equity. I'm going to take 603,400 plus 465,400, add them together and divide it by 2. And you're going to notice that this is coming from this line item called total stockholders' equity. So my average is going to be 534,400. So in my formula, I'm going to put in 534,400. So that means that my return on common stockholders' equity is going to be 39.63%. Okay. So how does my net income get divided by the total dollars invested from the stockholders? So we have 39.63%. Okay. The next ratio that we're going to be doing will be our return on assets. So that's part C. And return on assets, we're also going to be looking at our net income. So this is like another profitability ratio. So our return on assets, we're going to take our net income and we're going to divide that by our average assets. So for our average assets, I'm going to take 1,046,400, and I'm getting this total assets from our balance sheet, plus 872,300, and divided by 2. So our average assets is going to be 959,350. So when I take my net income and divide it by our average assets, 959,350, I want to assess how our assets help us generate net income. So 22.08% is our return on assets. Next, I'm going to be moving on to our liquidity ratios. So for our liquidity ratios, we have our current ratio, which is going to be using the information from this balance sheet. For our current ratio, we're going to take our total current assets, which will be 382,400. And we're going to divide that by our current liabilities of 208,000. So once you do the math here, you're going to get 1.84. And then we're going to be looking at our accounts receivable turnover. So we want to look at how are we able to look at our proportion of sales to our average accounts receivable. So here I need to scroll on up to my income statement so that way I can get my amount of net sales. And I'm going to need to divide this by my average accounts receivable balance, my average net accounts receivable balance. So my average accounts receivable is going to take 120,600 plus 105,600. I'm going to add them together, divided by 2, in order to get to my average accounts receivable, which is 113,100. So that gives me a accounts receivable turnover of 16.74 times in a year. So that means I'm going to make sales and collect on my accounts receivable about 17 times per year. But a related ratio is going to be the average collection period. So how many days does it take for me to collect on my accounts receivable? So average collection period equals 365 days divided by my AR turnover, which I computed to be 16.74 times per year. So my average collection period is going to be 21.80 days, which is fairly low, right? So within a month, you're able to collect on your accounts receivable balance, which is pretty good for most companies. Okay. Next, we're going to be looking at part G, which will be our inventory turnover. And for inventory turnover, we're going to look at our cost of goods sold, which is 1,061,340 divided by our average inventory. So we're going to compute the average inventory the same way. So when you do the math, you should end up with 122,450, and our average turnover should be 8.67 times. Similarly, if we looked at our days in inventory, we would end up with 365 divided by our inventory turnover, which will be 42.1 days, which is okay. All right, so to keep this video a bit shorter, I have included the formulas and the math for these last 4 ratios. We have the times interest earned, which is going to use the information from the income statement. We start off with our income before taxes, add our interest expense, and then we're going to divide that by the interest expense to get 13.89 times. For our asset turnover, we're going to take our net sales from the income statement and divide that by our average assets that we get from the balance sheet. So we need to compute our average assets using the beginning and the end of the year, add them together, divide by 2. So we see our asset turnover is 1.97 times per year. Then we need to look at our debt to assets ratio, which is our solvency ratio we learned at the beginning of the semester, where we're going to take our total liabilities and divide that by our total assets. So this should actually be 443 instead of 442. And we're going to end up with 42.34%. And our free cash flow is going to use some of this additional information that comes from the statement of cash flows. So you can read through this right here. Thank you for taking the time to watch this video.